A very good afternoon to all friends. I am Sanjeev Singhal, Chairman of the Auditing and Assurance Standard Board and Sustainability Reporting Standard Board of ICI. On behalf of the AASP, on my own behalf and behalf of my Vice Chairman, C. Vishal Doshi ji, I welcome you all to the 77th program of the AASB for this council year. Today's topic is related parties, audit, disclosure and compliance. And friends, so far 93,000 members have attended the various programs conducted by AASP this council year. And it's been our endeavor to conduct a session on each and every aspect of the audit of financial statements. So far, we have covered all the auditing standards. We have covered various guidance notes on auditing. We have covered the Schedule 3 and CARO, special aspects of audit of items of financial statement. We have covered each item, and now we are covering some other specialized topics. Friends, as you are aware that this year, we have also started an expert panel which answers your queries pertaining to audit of the companies as well as the non-corporate entities. We have enrolled 50 experts who are answering these queries of the members, and there is no fee for the same. And this panel is working till 30th of September. So please feel free to write your queries to the expert panel. And friends, it's indeed a pleasure for me today to welcome our worthy speaker, CA Paul Alvarez, who is a technical speaker and will be enlightening all of us on the topic. And our keynote speaker for the day, none other than the former chairman of the AASB, who was a chairman of AASB for 3 years. He was my senior council colleague when I joined the council, and he served the council for 9 precious years. And his passion for the subject and profession we have seen while being in the council. He was also an ex officio member of NFRA during these 3 years when he was the chairman of the Auditing and Assurance Standard Board. And he was instrumental in amending the CARO and bringing out the guidance note on CARO 2020. So thank you, Shekharji, for agreeing to join as a keynote speaker. Subject is yours, passion is yours. I'm just handling the baton that you passed on to us, and I would request you to kindly address the member on the topic. Thank you, and over to you.
Thank you, Chairman. When I was the chairman, you are my guiding force in the council, especially in the Auditing and Assurance Standard Board. And your experience is most valuable for not only for the AASB, but also for the Accounting Standard Board also. So first I thank considering me for this topic and gave me an opportunity to be a keynote introducing speaker on this topic. I also congratulate the AASB team taken a nice speaker, Mr. Paul Alvarez. I hope the audience will feel he is going to do the justice for the topic. Before going on the topic, I would like to remember the proverb. What is this, the SA 550, related party disclosures, all these things. My mind when the SA 550 related parties concept was notified long back, because all the auditing standards are, according to me of my 37 years practice, all are born child after I started practice, after I qualified as a chartered accountant. But even before that, the Indian history of laws, for example, why I am telling this point, the Auditing and Assurance Standard Board is the earlier birth of the 1980s. But my Indian Income Tax Act is 1857, prior to that. And subsequently it is 1922. And when we read the concept of this related party issue, SA 550, The Caesar's wife shall be beyond suspicion. So anything related to the transaction with the related party, for the stakeholders, it shall be beyond suspicion. Even as a professional, when we started learning the legal principle, we first learned the Contract Act. When we learned the Contract Act, we used to learn any contract done by misrepresentation or coercion or undue influence. According to this related party transaction, it is either maybe by a coercion or undue influence may happen. That is the reason the disclosure part arises. So that contract does not take validity in the Contract Act. So like that, the concept started with anything with undue influence or with coercions. I'm not going, because the speakers, I know that the concentration is mainly on auditing and assurance standards, SA 550, and he may covers along with that ASB accounting standard 18 as well as Ind AS 24. But I'm not going into the depth because it is a speaker's area. But where this is going to apply, I'm starting with my loving area of taxation. Direct tax, indirect tax, and I subsequently come for Companies Act. See, the definition of relative started in direct taxes in section 2, subsection 41. That definition, section 2, subsection 41, applicable for wherever the terminology relative comes, the transaction with the relative comes. What is the legal requirement under income tax law, which has been notified in different section? For that, there is a definition who is considered as a relative. As a fun, I used to tell both direct tax law and indirect tax law neither consider son-in-law as a relative nor consider daughter-in-law as a relative. Only Companies I consider. If you read direct tax law and indirect tax law, I'm talking about GST law, both the law neither consider son-in-law as a relative or daughter-in-law as a relative. They may be close relative within the four wall, but for the legal purpose, they are not at all relative. I'm talking about the general definition. Both section 2, subsection 41 of the Income Tax Act, as well as the GST law, where the definition comes. But at the same time, the relative concept definition, because we are going on the related party. If it is a statement of audit related to the charitable trusts who got themselves registered, financial statements on audit conducted by charitable trust got registration under section 12AA or 1023C. For them, there is a different definition of relative given in section 13.3, which is much wider definition. Because why I am taking that point, the audit party reference, the related party disclosure is necessary, taking the representation from the management. But these laws fixing certain responsibility, and if it is not satisfied, the benefit given under the law itself is withdrawn. For example, the transaction done with the related party, if it violates the conditions of section 13.2 of the Income Tax Act, read with section 13.3 definition of relative, the benefit of the exemption given to the charitable trust will be withdrawn, and their income is taxable at the highest maximum marginal rate. Present day, if you take, it will be more than 40%. So the auditor's responsibilities are there when they are doing a charitable trust audit with related to the definition of related party transaction. There, when I have to go for related party transaction, I have to not only keep in mind what is the auditing standard says, but I have to look into the section 13.3 says. If I go one step further, the same taxation law, I am carrying on a business. Then section 40A2, even in tax audit report, a specific reporting is essential. Transaction done with the person with whom you are interested under section 40A2. If you go to the definition of 40A2, why I am taking these areas, generally people think accounting standard, auditing standard only for companies. Generally. But when I am doing an audit of a tax audit, because nearly tax audit is more than 30 lakhs cases done tax audit, non-corporate assessees are there. We are making a specific clause disclosure under section 40A2. There in 40A2, for each category of person, they define who shall be considered as a relative. Indirectly, they will be considered within the definition of related party. For example, individual who is relative, HUF who is relative, firm and LLP who is relative, company who is relative, any other person means body of individual, AOP who are relative. A separate definition category of person that is exclusively for the person declaring income under the head profit and gains of business or profession. And when they are making a reporting under form 3CD, this requirement will going to come in apply. Further going inside, even this is also a part of the reporting which come in tax audit. Gift, section 56, 27B, old section, new section is there, 10, all these things. A new definition of list of relative is given. Each relative definition, general definition of relative under section 241, 13.3 definition, 40A2 definition, section 56 subsection 2 definition for gift, all the relative definitions differs. Same thing in GST law. If you see in GST law, there is a separate definition of relative. They are calling it as persons deemed to be a related person. For the purpose, both in GST law and direct tax law, what is the main? Even in auditing standard, accounting standard, the purpose of verifying the related party transaction, minimum it should be in arm's length price. That should not be excessive or unreasonable. Because of the related, the person should not take undue advantage of the organization, undue benefit derived from the organization. So that is the reason. So the area is the most important thing. And our responsibility is also high. Why I am talking this point? Ultimately, I was also in the disciplinary committee for 4 years when I was in my 9 years period of counsel. Majority of the cases, we are fixing the chartered accountant guilty only under section that is schedule 2, part 1, clause 5, 6, 7, 8, 9. Clause 5 to 9, mainly 7, 8. Very, very important. Schedule 2, part 1, clause 5, 6, 7, 8, 9. These classes are the mostly important classes whenever you are doing the attestation function, because these classes only talks about the material facts not disclosed, the material statement, what you are supposed to obtain, you are not obtained. The auditor has not exercised the due diligence and care when he is making a reporting. So in all these areas, this related party disclosure and the statement of disclosure and the verification came into a major role. So considering the area of our operation of audit, area of operation of our consultancy and attestation function, the AASB has chosen a right topic at a right point of time. Why I am taking this right point of time? This is the month of mainly on tax audit, where it is more essentially going to play, because more than company, the transaction with the relative. For example, I can go individual. Individual, not only the relative definition, the relative's relative or the concern in which this relative is having substantial interest, they widen the definition. It may be a firm, it may be a company, it may be an LLP like that. So we are having, which is having a major important role in our day-to-day reporting on attestation on audit function. So we are having an excellent speaker with a excellent background who will give you a satisfy all your queries and requirements. I thank the whole of the committee of the WASP present committee and specifically our chairman Sanjeev Singhal gave me a great opportunity to be an introducer and a keynote speaker on this happiest occasion. Thank you, Chairman. Thank you all.
Thank you very much, sir. Thank you very much. And the way you linked income tax with the audit, that's an art which we are losing because of specialization. And only a person of your stature could link the two. Because I remember when I was working in the corporate sector, I was working with Mr. K.K. Tulshan. CA K.K. Tulshan was our executive director. And he had this art of linking taxes with the financial statements, saying that it needs to be holistic and it can't be in isolation. And I'm saying that as the audits are becoming more complex, we are losing this art because of the hardcore specialization. So thank you for driving home that point, sir. Your thoughts are always very valuable, and we know that you're a renowned author as well. You have authored, you have shaped the destiny of so many students of chartered accountancy. So thank you for all the difference that you're making, sir. And it is now, thank you, sir. It is now a pleasure to introduce Paul, as I pronounce him. Paul is, besides being a chartered accountant, is a cost accountant as well, and has an experience of post-qualification experience of 24 years, which equals my experience as well. And he has worked on a range of assignment and on Indian GAAP, Ind AS, IFRS for very large listed company. And he works in pharma, infrastructure, and auto sector space. And his in-depth knowledge of capital market transaction, including IPOs, QIP, bond issue, etc. He has been a special invitee of our own accounting standard board. He's also been a member of the ICI study group for drafting guidance on CARO 2020. And he's been associated with many initiatives of ICAI. He's also an expert on REIT and InvIT. So thank you, Paul, for taking out time. The screen is all yours. The topic is your familiar topic. And towards the end, Anil Alji will be taking up the questions that we will receive from the members.
Sure.
So all yours, Paul. And thank you for agreeing to be a speaker today.
Absolutely. Thanks, Sanjeev. Thanks, Shekharji. Anil, just tell me whether my screen is visible.
Yes, sir. Fine, sir.
Yeah, it's okay. Okay.
Yes, fine.
So thank you very much. And I think I couldn't have had better professional colleagues, introducing the topic. Sanjeev is a very, very knowledgeable speaker, and Shekhar Saab, I think you've probably done a better job than me in giving a introduction to this topic. And you used a very famous proverb, if I may say, of Caesar's wife must be above suspicion. So probably, I don't know how many people in the audience would know, but this was presumably used somewhere when Caesar gave a justification for divorcing his wife. And the logic was that if one is involved with a famous or a prominent figure, one must avoid attracting negative attention or scrutiny. So basically, you need to be holier than thou, if one may say, in some sense. So and I think you wonderfully linked it to income tax, giving the importance of why related party is such a sort of the topic. So with that, I'll just move on. So when I've made this presentation, I've been given a free hand in terms of what I wanted to cover. So I thought relevant, to cover the accounting standard aspect, cover the Companies Act aspect, cover the SEBI aspect as well, because there are different regulators looking at related parties, and without understanding the the gist of the concept of related party, the reason why and what are the latest changes, it's difficult for anyone to do audit of related parties. So with that, I'll move on to this topic of related parties. So screen is not moving. Yeah. So why is, firstly, just to give you a background, why is related party such an important topic with regulators? You just think about it and bring a, kind of a analogy to your own lives. If you were doing a transaction with any person that you are not related to in a sense, okay, a third party person, okay, let's say you're selling a property to a third party, okay. You would try to extract the best price from that third party, right? Okay, because and hence that price is assumed to be a fair price because it's a price which would satisfy you. You would believe that that's a price which is representative of the value of that property, and hence you would transact it at that price. Now let's presume that you need to do a transaction to transfer a property to your wife, okay, and it has various implications, okay, let's say income tax implications, stamp duty, and various other things. It would be very natural on your part, okay, being a human, to try and minimize, okay, the value of that property to ensure that income taxes are minimized at your end in terms of the cost of income tax and even the cost of stamp duty on the borrower side. So the concept of related party typically comes in from this kind of underlying presumption that in a related party transaction, okay, both sides of a transaction are somewhere controlled / influenced by the transacting parties. And that is the reason, there is so much attention given to this topic, because if it's not a related party, generally, the transactions are presumed to be at fair prices. But if it's with related parties, okay, that presumption of fairness in a transaction tends to get vitiated because the two parties tend to be related to each other, and hence can influence the price to achieve their objective, okay, and hence that price may not be a fair price. Here, when we mean terms, okay, okay, the terms need not only be price. Okay, the terms can also mean terms of payment. Okay, so terms basically with any party need not only be the transaction price. I'll give you an example. For example, you are transacting with a party and you say that I sell you goods worth 100 rupees, and with an unrelated party you would say you pay me that consideration upfront. But when you're doing a transaction with a related party, you may say, okay, pay me this after 20 years. Now, if you say pay me after 20 years, effectively the present value of that payment is almost zero. Okay, so terms of payment, okay, need not necessarily be only price, and that's the reason whenever a related party transaction is looked at, the related party transaction is always looked at in terms of the terms of payment, terms of the trade with the related party, and not necessarily the price. Okay. Second, the other important point here is that the transactions with related parties, why do they become important? Okay, from various regulator perspectives, okay, especially for us as chartered accountants, is because primarily they impact financial statements. Okay, be it and hence because they impact financial statements, okay, they would be of relevance to a person who's preparing financial statements, and hence an auditor's angle or an accountant's angle while preparing financial statements. They may impact income tax, like Shekhar Saab said, 48(2)(b) or various other sections of income tax, okay, where they may have an implication. They could have an implication from a regulator standpoint, like an MCA or a SEBI. So various regulators, okay, are interested, okay, in ensuring that the related parties are conducted at arm's length price. Now, one thing that you would notice, and sometimes, it's a question where, where when I deal with clients, okay, one of the things is, why can't we standardize the definition of the related party? And if you see, and when we come to, the subsequent slides, we'll see that the related party definitions, okay, are different in probably with every regulator. And honestly, I believe that, this will always be the case. Okay. The reason being that every regulator is trying to regulate some aspect, okay, of his interest. And that is the reason it is formulated, okay, with that interest in mind. So for example, of 48(2)(b), okay, could be formulated with a particular intention. A 276 under Companies Act could be formulated with another intention. Okay, a Reg 23 under SEBI could be formulated with a different intention, where related party has been taken to be at a group level, something which was never ever there, okay, in past history. So every regulator has a particular objective to meet, and hence the definition of related parties, okay, is something that is, you would find it to be different under probably every regulation or every act or every standard, so to say. Because each stakeholder's interest is different, their definition is different, and hence related party definition may not be consistent across regulators. Now, because it is not consistent across regulators, that makes the job of the accountants and hence the auditors slightly complicated, because somebody could be a related party under some regulation, and he may not be a related party under another regulation. And typically, accountants and auditors, always moving on substance over form, may want to treat a related party to be a related party wherever it is triggered as a related party. Okay, and sometimes clients may not take that position, and hence they may go legal, take a legal view. So that's the reason this becomes complicated. The subject of related party becomes complicated. So what we discussed here is basically why related party is important. Okay, now what are we covering today? Okay, one, we are covering Ind AS. Okay, because the larger canvas of clients, if I may say, across the country. Okay, Ind AS is applicable now, either through application to them or through subsidiaries and associates. Okay, second is the Companies Act and SEBI regulations. Okay, I've tried to make it as simple as possible. Whilst it may not, the subject may not be so simple, but I'll try and try and cover it in as simple terms as possible. Okay, okay. So firstly, on Ind AS 24, okay, like Shekhar Saab mentioned, okay, Ind AS 24 is a disclosure standard. So most stuff with related parties, okay, will be to do with disclosures. Okay, so that and why it's an important disclosure standard is because people who are reading, okay, that literature or that data know how much of that is done with related parties. So for example, if one is preparing financial statements, and let's take two scenarios. One is those financial statements do not indicate how much is the transaction with related parties, vis-a-vis another set of financial statements, okay, where it discloses the amount of transactions with related parties. Okay, the second scenario is more informative to an investor, okay, is more informative to the tax department, is more informative to any person who sees those numbers, because the lens through which he sees a related party transaction would be different from the lens through which he would see a non-related party transaction. Okay, so disclosure is the most important aspect, okay, as far as Ind AS 24 is concerned. Okay, now what are some of the important aspects, okay, of Ind AS 24? One is identifying the related party. This I think is you can say 70%, 80% of where the effort goes, and that's where the cat and mouse game, if I may call it, okay, is between any regulator and any regulatee. Okay, so people may say this person is not a related party, or this entity is not a related party, and a regulator may try to bring it within the ambit of the related party. So most of the regulations or the change in regulations that you will see is from the perspective, okay, of trying to identify the related party. Okay, so first thing is who's the related party. Second is what are the transactions, okay, or which type of transactions with related parties are covered. Okay, and third is what type of disclosures are covered. Okay, So firstly, let's look at who is a related party from an Ind AS 24 perspective. Now, Ind AS 24, looks at it from a reporting entity perspective, the entity for whom you are preparing financial statements. Now, one thing I'll need to caution you here is some of the stuff which I've written here, is more colloquial for understanding, because if you go by the core definition, like for example, I've written parents, siblings, these are not terms which are used there, but they'll use father, mother, the siblings, brother, sister, so I just tried to make it as simple so that from a understanding perspective, you get a better understanding. So these are not the technical words used here. So one is from a reporting entity standpoint, there are two categories, if I may say, of people who are related parties. One is firstly an individual. And now let's stick our discussion to individuals. Now within individuals, who are the people who can be related parties? So within individuals, the related party can be the individual himself or a close family member of the individual. So individual, it's easy to understand. So which kind of an individual will be an individual who would be considered as a related party? He needs to be an individual who has control or joint control, if I may say, on the an individual who has control or joint control on the reporting entity, an individual who has significant influence on the related party, or an individual who's a KMP of this reporting entity or of its holdco. This is the only place where the holdco is brought in. So first we are dealing with individual as a related party. The individual needs to have either control or joint control, significant influence, and I'm not getting into the definitions of each of these, or he needs to be a KMP of either this entity or a KMP of the holdco. Notice that this is the only place, in KMP where the holdco is brought in. And each may have its own rationale. I'm not getting into the rationale of why they've brought in these, aspects. Second is, who is a person who's a close family member of this individual. So now we are assessing related party only from an individual's perspective. So the individual himself or somebody connected with the individual who is called as a close family member. Now, who is that person who's a close family member? So the close family member will be a person who can influence, or get influenced. So somebody who influences him or somebody who he influences, can be a close family member. And remember, there is an element of judgment. I'm sure that in your minds you will have this, how do I determine this? So there will be an element of judgment out here. Second, is there are certain people who are presumptive close family members, who are presumed to be close family members. So if you take an individual, his parents, mother, father, his siblings, brother, sister, I think somebody mentioned sister-in-law, brother-in-law is not a related party. Sometimes, that may be the case. So parents, mother, father, siblings, brothers, sisters, spouse, or I think DP is domestic partner. These are standards which are inspired from IFRS. A little bit advanced for the Indian culture. But you can assume for India it is spouse or spousal equivalent, you can say. And children and dependents. Typically of the individual and the spouse, their children and dependents. These people are close family members. So either the individual or the close family member, needs to have control or joint control, significant influence, or be a KMP, of either the reporting party or of the holdco. These individuals, will be treated as related parties under Ind AS 24. Now we move on to entity. So this, what we discussed on slide number 4, is for individual. Now we are discussing for the entity. For the entity, it becomes a little more complicated, if I may say. Okay. If we take the entity, okay, so we are determining for the reporting entity. Okay. So if the entity and the reporting entity are part of the same group, okay, typically meaning that they have the same parent, okay, they would be related parties. If the entity is an associate or JV, okay, then it will be a related party. Okay. If it is an associate or JV with a member of the group, okay, then it will be a related party. If it has a JV partner in common, this is very, very, unique, if I may say. Okay. If it has a JV partner in common, it's not referring to, remember, it's not referring to two JV partners. Okay. Let's say party A and party B are JV partners in an entity C. Okay. It's not talking of A and B. It's saying that A has a joint venture with reporting entity and A has a joint venture with the entity also. Okay. The JV partner is common. In that case, they will be related parties. Okay. Common third party. Okay. So the same one over here where JV with reporting entity and JV with entity are related. Similarly, they are saying JV with reporting entity and significant influence on the other, or vice versa. Okay. They are also related party, and certain other things like post-employment benefit plans, etc. Okay. So these are certain entities. Certain other entities also may be related parties. Okay. So certain individuals. Okay. Now these are mostly entities that we've covered here. Certain individuals. Okay. Which individuals? The ones which we discussed on the previous slide. I'm just going to the previous slide. These individuals. Okay. All these individuals. Okay. If they have control, okay, over the related party, okay, and control on the entity. So the individual in slide 4, okay, who's having control over the reporting entity and also has control on the entity, they become related parties. Okay. If the individual, okay, who has control over the reporting entity has significant influence or a KMP. Okay. So the first one is the individual is having control on the reporting entity and the individual is having control on another entity. Okay. Both those are related. Second one is the individual who's having control over the reporting entity and is having significant influence or is a KMP of the other entity. They are related. And thirdly is entities providing KMP services to the entity or the parent. Okay. So these become related parties under Ind AS 24. One thing which is very important, okay, and which the reason why I've highlighted it in bold is because most interpretations of related parties, most debates with clients would happen on legal. And the intention of the standard is substance. Okay. So substance of the relationship, okay, is more important and not merely the legal form. Okay. Somebody may on paper say that, there is no control. Okay. But effectively may have control. Somebody on paper may say that there is no significant influence, but his actions and decisions and, transactions may indicate that there is significant influence. Okay. So substance of the relationship is more important and not merely the legal form. Now moving on to who is not a related party. Okay, so we covered who are related parties. We covered certain individuals who would be related parties. We covered certain entities who would be related parties. Now the question is who is not a related party. Okay, entities having common directors. Okay, if these were related, so really if you go down to the substance where we began from, okay, they do not see a situation where people, if they are just by virtue of having common directors, those entities having a influence on transactions, okay, which happen between the entities, and hence probably, okay, these are excluded, or transactions having or entities having the same KMP. So let's say if Ratan Tata is a director in X entity and he's also a director in Y entity, just by virtue of these two entities, okay, having common directors doesn't make them related parties. Okay. Second is two joint venturers because they have a joint control on a JV entity. I mentioned this earlier. If I have an entity C, of which A and B are common joint venturers, A and B do not become related. But if A is a joint venture partner with C, and A is also a joint venture partner with D, okay, then C and D become related parties. Okay, so if you have a common joint venture partner, will become related parties, but the joint venturers themselves are not related parties. Third is a trade union of an entity. Okay, probably these are specifically excluded because of, you know, somewhere a presumption that there could be an influence. Okay, so specifically excluded. Trade union, okay, is not a related party. Lenders, customers, suppliers, franchisors. Here, you know, the extent of transaction or the extent of fund involvement, if I may say, is very large, and hence it is specifically, let's say, for example, you know, a company has almost negative equity and it has a lender who is so powerful that he's almost having control on the entity. Okay, but the lender, okay, of finance, okay, his interest is only you know, to lend money and to earn a return on that money. Okay, and hence, you know, it is not considered as a related party because it's a third party. Okay. Also customers, suppliers, franchisors, distributors, dealers. Okay, here just because of volume of business, let's say you're you know, a dealer, okay, a company but a dealer of XYZ company, and your entire business is with that company. It doesn't, and of course there will be influence on the pricing, etc. But this is specifically excluded, presumably because, you know, these policies apply to all dealers and distributors together, you know, and hence, you know, there is an inbuilt arm's length, if I may say, okay, as far as these relationships go. So these are specifically excluded as related parties. So we covered what is a related party. We covered, you know, what is not who is a related party. We covered who is not a related party. Okay. Now what we'll cover is related party transactions. Okay. Now, based on a colloquial understanding, okay, it appears that for there to be a transaction, okay, there needs to be a debit and a credit. Okay, but really that's not the case. So the way the standard is worded, okay, is transfer of resources, services, or obligations. Okay. So if there is a transfer of resources, okay, from any one entity to another entity, okay, who is the related party? So firstly, you need to determine, okay, which is the entity that you're auditing or preparing accounts for, okay, which is your reporting entity, and which is an entity, okay, for which you have determined this entity to be a related party. Okay. So that presumption or that work has to be done prior to arriving at a related party transaction. Now, between these two entities, okay, if there is any transfer of resources, services, or obligations, okay, you supplied goods to this entity, you have purchased goods, you know, you have provided certain IT-related services, you have provided manpower to the entity, okay, so all of those, okay, you have taken a loan from the entity, all of those, you know, will be covered. Now, certain important elements, it is not necessary that a price is charged. And hence I said there is no need for a debit or a credit. Now, which could be transactions of this type? Okay, typically you see situations, okay, where, you know, SAP implementations, okay, happen at a group level, okay, and some entities are allowed to use the SAP, okay, free of cost. Okay, it's possible it happens in many companies. That free of cost transaction, okay, is a transaction. Let's say the reporting entity spent all the money for the SAP, okay, and the entity, which is your related party, is a subsidiary, and it's allowed, okay, to use the SAP free of cost. Okay, there is an instance created for it, okay, and it is allowed to use, and no charges, okay, are levied. From an income tax perspective, there is a separate matter in terms of, you know, for transfer pricing purposes, if it's material and, you know, it needs to be considered. But from an accounting standpoint, okay, it will still be a matter of disclosure because there is a transfer of resources from one entity to another. Okay. Second is, like I said, no debit or credit transaction necessary. Okay. Now, there could be a situation, okay, where this entity has taken a huge borrowing from a bank, or a borrowing, let's say a borrowing from a bank, for which a guarantee, okay, has been given by this reporting entity, okay, on behalf of this entity. Okay, that commitment or guarantee, okay, becomes a related party transaction. So there is no debit or a credit over there. but it's a commitment or a guarantee which is being given. Okay, there is an obligation, if I may say, okay, which this entity is taking on behalf of this entity, and because of which it becomes a related party transaction. Okay. Certain other important matters as far as Ind AS 24 is concerned is it is a disclosure standard, okay, and it does not deal with recognition and measurement. So it does not tell you at what price you should, recognize, even though it somewhere presumes, okay, that the transaction is being done at arm's length, okay, but it is not regulating that, okay, it is only a disclosure standard. The evaluation and disclosure is only with respect to the reporting entity that is preparing financial statements. Okay. Now, the reason why I'm mentioning this is because, under Reg 23 of SEBI, okay, a lot of changes have been brought in where related parties are evaluated at a group level. Okay. But Companies Act and the accounting standard, okay, evaluate related party, okay. The disclosures are obviously done, okay, at a console level as well, okay, but the evaluation is between a legal entity to a legal entity, okay. So it's not that a related party of a subsidiary is a holding company's related party. You'll never have a situation of that type, okay. So evaluation and disclosure is only with respect to the reporting entity that is preparing financial statements, and hence the evaluations are at a standalone level and are added or eliminated when preparing CFS. So whenever you're doing CFS, okay, these are consolidated financial statements, you would add all the related party transactions, save for eliminations, etc. Okay, and then net items remaining after elimination is shown in the consolidated financial statements. Okay, so under Ind AS, okay, evaluation is not done at a group level, unlike as required under Reg 23 of SEBI regulations. Now, what are the disclosures, okay, which are required to be given for a related party? Okay. Now, following are the important disclosures. First one is if any party, okay, is controlling the reporting entity, then you need to give a disclosure, okay, of who's that parent, okay, who's controlling, and the ultimate parent, irrespective of whether there are transactions between them. Now, this is important, okay, because this is the only situation, okay, in which you need to make disclosures irrespective of transactions. Otherwise, all the disclosures and related party standard, okay, are disclosures which you have to give in terms of the transactions of a related party. So if you don't have a transaction, you may document that there is an existence of a related party, but there is no transaction. But in a situation, okay, where you have a parent, okay, then irrespective of the transaction, whether it happens or not, you need to disclose that there is a control relationship, okay, between your reporting entity and the parent entity. Okay. So what are the disclosures to be given? Firstly, like I said, disclosure you need to give of the parent and the ultimate parent. Secondly, compensation of KMPs, okay, in total is to be disclosed under certain specified heads. Like, for example, short-term benefits, long-term benefits, the share-based payments, etc. Okay, so I've not detailed out everything because it then becomes very clustered on the slide. Okay, so compensation of KMPs is to be disclosed. Okay, if there are transactions with related party, then the following minimum disclosures are required to be given. Firstly, is the nature of transaction. Okay, which typically would be purchase, sale, borrowings. Okay, and remember over here, okay, it is only one-sided, okay, always, okay. The cash side of the transaction is not disclosed as a related party. So, for example, if I if I do a purchase from a related party, then the payment I'm not showing as because it's a settlement of the same transaction. Similarly, if I take a loan from a related party, okay, repayment of the loan is not a related party because it's the same loan which I've taken. Okay, but if I've given a loan to the related party, okay, then I will show that. So nature of transaction, okay, is important. Second is the amount of the transaction. Okay, at what price, okay, did that transaction happen? Okay. Third is the the balance which is payable or receivable from the related party, which is typically the period end balance or the year end balance, if you may say, okay, at which you are preparing the financial statement, including provision for doubtful debts, okay, outstanding, and the P&L debit of the doubtful debts. Third, the next one is on guarantees. Okay, given and received. Okay, what are the extent of guarantees that you've given and you've received? Disclosures shall be given under certain specific categories. Okay, now these are all types of related parties. So one is, if you may put it in a matrix form. Okay, let's say, okay, you will have a situation where on the one second, let me just put it in that form. Okay. Okay, you may have a situation, okay, where, okay, you put it on this side, okay, as type of related party, okay, and here in terms of nature of transactions. Okay, so these are all nature of transactions, and these are all places, okay, where you have type of related party being disclosed. Okay, so it typically goes in a matrix form. So here you will have parent, subsidiary, associate. Okay, you have entities with joint control. Okay, JVs, KMPs, etc. And here you will have purchase, sale of goods. Okay, a fixed asset. And typically, what you need to remember is transactions which are of similar nature can be grouped. Okay, but transactions which are different in nature, like you can't group a purchase of fixed assets with a purchase of raw material, okay, because they are not similar. But if you have purchase of various types of raw material, okay, you can group them together. Okay, there are certain places, okay, very typical places where you may face challenges at times, okay, when you disclose related party transactions. Okay, for example, you made a provision, okay, for an outflow of resources, let's say a compensation which is to be paid to a related party, but it has not been decided within the group how the allocation of the compensation will happen. Okay, so basically, which is the related party to whom you are going to back charge, and how it is going to be back charged at year end. Okay, because that has to be done on the basis of, let's say, an extensive study, etc. Okay, in that situation, you may face a challenge. Okay, in terms of who the transaction with, or which is the related party with whom you have the transaction, and what is the amount, even though you have determined the value of the transaction. Okay, how do you allocate it amongst the respective related parties? This could be some specific situation where you may face this. Okay, the disclosures are made that transactions with related parties were made at arm's length. This is made only if such terms can be substantiated. So this disclosure, typically you will see. So I mentioned earlier that Ind AS 24 is a disclosure standard. Okay, but it is a disclosure standard with the presumption, okay, that there is an arm's length, okay, which is embedding all the transactions which are being done. So the disclosure is made that these transactions are being done at arm's length, even though it is not regulating the recognition and measurement. Still, somewhere from a backdoor perspective, it is trying to indicate, okay, that the transactions need to be recognized and measured at arm's length. Okay. So this is as far as the Ind AS 24 kind of goes. Okay. Then coming to Companies Act. Now, Companies Act is very, very broad, okay, in terms of related party, and multiple sections which deal with related party. So I picked up certain sections which I thought were relevant and for this audience within the time that we have. Okay. And hence, I'll cover those sections, typically 188, 185, 177. Okay, those are the sections which I'll be covering. Okay, now to begin with, one of the most important sections, okay, is like Shekhar Saab mentioned, okay, was 276. Okay, so related party, okay, as per Companies Act, the definition comes from 276, and under 276, if you see, okay, it's a very broad definition. Now just keep this definition, just mentally compare it with the definition that we did under Ind AS 24. Okay, now the 276 definition, okay, defines a related party as a director or his relative, a key managerial personnel or his relative, a firm in which such director, manager or his key or his relative is a partner, a private company in which such director or manager is a member or a director, a public company in which he has to be a director or a manager plus hold 2%, okay, of the paid up share capital, and any body corporate whose board of directors, managing director or manager is accustomed to act in accordance with the advice, directions, or instructions of a director or a manager, and any person on whose advice, directions or instructions a director or manager is accustomed to act. Okay, if you notice, and then you have certain things which have been added recently. I think in 2018 or 19. Okay, a holding subsidiary associate of such company, subsidiary of the holding company, and recently added is investing company or venture. Investing company basically means if A is a holding company, okay, and B is the associate, okay, then B was reported as a related party, but A is the investing company in that. And similarly for a joint venture, okay, where you have a joint venture which is B, and A holding in B, A becomes a venturer. Okay, so it's nothing but the other side of associate and joint venture, which is considered as a related party. So if you see the definition of related party under Companies Act, okay, like I mentioned earlier, you'll never find definitions which will align. Okay, each regulator drafts it according to his own objective, what they're trying to regulate. So they are different in terms of, you cannot put them in a table as well. Okay, it's very complicated. But there are certain concepts in Companies Act, okay, which are not there in Ind AS 24. Okay, like accustomed to act. Okay, even though it is there in some form. Okay. Where it says that an individual, okay, who is accustomed to who is under the influence of, or who influences somebody else, okay, so that is almost like accustomed to act. But this concept of accustomed to act is primarily, okay, in Companies Act. The threshold of 2%, okay, for public companies, okay, is not there, okay, in Ind AS 24. Certain concepts which are there in Ind AS 24, okay, those are not there in Companies Act. Okay, like two companies, the common JV partner, okay, being a related party under Ind AS 24, that is not specifically covered here, okay, in that form in 276. Okay, so 276 has to be looked at differently, if I may say, from Ind AS 24 when you're looking at related party. Okay. Now coming to certain important sections of Companies Act, okay. 188, okay, is one of the important sections of Companies Act, okay, which regulates typically 7 types of transactions. So what 188.1 says, I've not put the entire section 188, just put 188.1. It says, except with the consent of the board of directors given by a resolution at a meeting of the board and subject to such conditions as may be prescribed, no company shall enter into a contract or an arrangement with a related party with respect to sale or purchase or supply of any goods or material, selling or otherwise buying or disposing of property in any kind, leasing of property of any kind, availing or rendering of services, appointing any agent for purchase of goods, materials, or services. Such related parties appointment, okay, to any office or place of profit in the company, its subsidiary or associate, and underwriting the subscription of any securities or derivatives thereof of the company. So if you realize, these are 7 transactions, okay, which are being regulated here. Certain important points out here. Okay, one is, like I said, it covers only these specific 7 types of transactions. Okay, it does not cover transactions like loan, reimbursement, remuneration, and there could be many other types. Okay, which are anyways required to be reviewed by the audit committee. Okay, it is not covering those. Okay. What is important here, okay, is 2 important concepts, okay, which are not there as far as Ind AS 24 is concerned, okay, which we didn't see in that form, okay, really. One is ordinary course of business, okay, and arm's length, okay. Now, what is important over here, okay, we'll come to what is ordinary course and arm's length, okay. If the transaction, okay, is not an ordinary course, but it is at arm's length. Okay, like let's say it's a transaction which doesn't happen regularly. It's a transaction of that year, never happened in the history of the company, but it's an arm's length transaction. Still, board approval is required. Okay, if it's a transaction, okay, which is in ordinary course but not at arm's length, okay, board approval is required. And if not in ordinary course and not at arm's length, okay, board approval is required. Okay, so the situation, okay, when board approval is not required, is a transaction which is in ordinary course and at arm's length. Okay. So if the transaction is in ordinary course and the transaction is at arm's length, okay, then board approval is not required as per 188.1. But either one of them is missing or both are missing. Okay. So in the first case, okay, ordinary course is missing, but arm's length is there. In the second course, ordinary course is there, but arm's length is missing. And in the third case, both are missing. In all these cases, board approval is required. Okay. Audit committee approval anyways is required. Okay. Now, additionally, as an additional layer, okay, shareholder resolution is required, okay, in case certain transactions, okay, exceed certain thresholds, okay, during the previous year, okay. These thresholds, okay, I have not put the threshold transaction wise, again, due to limits of the, presentation, okay, makes it very cluttered, okay. So there are various thresholds. Those thresholds are typically 10% of turnover, 10% of net worth, or 1% of net worth. Okay, as per previous audited financial statements. Okay, so if these thresholds are crossed, then shareholder resolution is required. Okay, they're basically nothing but a materiality threshold. Okay, so if the transaction is material, then shareholder resolution is required. If transaction is not material, board approval is required. If everything is okay, then audit committee approval is required. Okay, so that's 188. Now there are certain typical, things which are important. Okay, one is what is an arrangement, and I've always, personally felt that the literature that you see across any regulator is the literature across identification of the related party. The discussion on ordinary course or a discussion on arm's length, you'll probably not find that in that level of depth. But the real issues that you face practically are on ordinary course and arm's length. Okay, besides related party, because related party still has an easier way. Okay, it is codified, but ordinary course and arm's length is not codified. Okay, if I may say, in that level of detail or clarity. Okay. So what is an arrangement? Arrangement is a term which is, now where does this word arrangement come in? Okay, here it comes in. Okay, in 188.1, any contract or arrangement with the related parties. Okay, so what is an arrangement? The term arrangement is not defined, okay, in Companies Act. However, I've just taken a, you can refer to any form of literature. Okay, but under Competition Act, okay, it defines an agreement. Okay, and within an agreement, it says that it includes an arrangement, whether or not it is formal or in writing, or whether it is and whether it is intended to be enforceable by legal proceedings. Okay, so typically a verbal agreement, okay, also can be an arrangement. Second is, what is ordinary course? Now this is something, okay, that is very, very difficult. If I may say, there is a huge amount of judgment, okay, that is required. Because your approvals, okay, are getting triggered on based on, just a second, please. Your approvals are basically triggered on whether a transaction, okay, is in the ordinary course or the transaction is not in ordinary course. Okay. Now there are certain indicators, okay. I've just picked up certain from the ICSI guidance, so the equal amount of guidance available in the C literature as well. Okay, but what is important here is whether the transaction is routine, whether it is repetitive. Okay, whether the industry, okay, has under the industry, okay, this transaction is considered as routine. There is a huge amount of judgment, okay, involved in whether a transaction is an ordinary course or not. Okay, for example, okay, a huge property, okay, or a plant, okay, being sold by one related party to another, whether it's ordinary course of business, okay, if you go down to the memorandum, probably it is permitted, okay, whether it is routine business, somebody may argue that it is still routine in nature because it is relating to the business, okay, in which both these entities are. So lots of transactions may appear routine, but whether they are ordinary or not, there is an extent of judgment which is required, and this doesn't have a bright line test, okay, in terms of determining transactions Okay, there is a transaction which may appear ordinary for one set of business, may not necessarily be ordinary for another sort of business. Okay, let's say a transaction, okay, which is a convoluted transaction, okay, done through various methods, if I may say, for achieving a particular objective, okay, or bypassing a law, okay, or bypassing a particular provision of law. You may want to treat it as not an ordinary course. Okay, so like I said, there is an element of judgment required. An activity which is routine and in accordance with the usual customs of trade practice may be treated as ordinary course of business. Okay, now this is easier said than done, but practical application is important here. Okay, and there is an element of judgment required in this case. What is arm's length? Okay, here, arm's length probably has, tons of literature, under Income Tax Act. But unfortunately, as far as, Companies Act is concerned, or accounting standards, it is, beyond a statement. Okay, there is not much literature available in terms of what is considered, okay, to be an arm's length transaction. Okay, and how do you evaluate arm's length? Because, like I said, you can identify a related party well. You can identify whether it's ordinary course or not ordinary course, probably. Okay, but what is the price? Okay, of arm's length? For example, you go to income tax. Okay, it will give you a range, and that range probably could be the range which is effectively, from a governance standpoint, let's put it. Okay, from a governance standpoint, okay, it may give enough leeway to the transacting parties to achieve their objective. Okay, but in the absence, okay, of detailed literature, okay, so what does arm's length really mean? It's basically as if the parties, okay, were unrelated and there was no conflict of interest. Okay, so what price would be charged in that situation? That is considered as arm's length. Okay, now this definition, like I said, is very simplistic. Okay, and for Companies Act purposes, there is no framework. Okay, but, and like I mentioned earlier, arm's length doesn't mean only price. It means the terms of the transaction. Okay, it is the transaction which needs to be at arm's length and not the price only. Okay, so that is important. In the absence of specific guidance, okay, many companies, okay, or most companies, if I may say, use income tax, okay, as a basis for arm's length. Like I mentioned, income tax has various methods, okay, which it prescribes, and also a range, okay, in which it may determine an arm's length transaction. Okay, if and in the absence of anything to say that that is not permitted, okay, it has been used as a market practice. Okay, even if you have a single transaction, okay, in which you are able to demonstrate arm's length, okay, you may be able to justify that arm's length is fulfilled, and there's nothing to stop you, okay, from arguing. There's no framework really of determining that this transaction is not at arm's length. Okay, and it is of course strongly recommended, okay, that considering the significance of the topic of related parties and arm's length, okay, I think guidance on arm's length and guidance on that framework of arm's length is an important, especially from a governance and an investor standpoint. What is meant by arm's length needs to be brought out much more elaborately, okay, than using an income tax method, which is widely prevalent today in the industry. Okay, next, moving on. Okay, section 185. Okay, this typically relates to loans. Okay, so 185.1 says that so we completed 188. Okay, so 185 typically says that no company shall directly or indirectly, okay, advance any loan, including any loan represented by a book debt, to any of its directors. Okay, so these are typically loans to directors or persons in whom directors are interested, and loans also includes guarantees or amounts through book debts, okay, which are loans represented by book debts. Okay, now there are certain types of transactions which are prohibited, okay, and there are certain types of transactions which are permitted, and those which are conditionally permitted. Okay, the ones which are prohibited are typically loans to directors of the company or to directors of the holding company, to any partner or relative of such director, and any firm in which such directors are interested. Okay, it is also prohibited, okay, to private companies in which such director is a director or member, or body corporates which are accustomed to act, or where you have 25% voting power. Okay. But if there is a special resolution and those entities, okay, in which typically these three categories are categories in which directors are interested, okay, if these entities utilize the loans, okay, for the purpose of principal business activities, okay, then these loans are permitted. Which are the loans which are conditionally permitted? Okay, loans to directors are not allowed, but loans to MD and whole-time director, okay, is allowed, provided it is permissible to all employees and it is under a scheme which is approved under special resolution. Then it is permitted. Loans between Holdco and WAS, okay, which is a wholly owned subsidiary, is permitted. WAS over here can also, for companies act purposes, mean indirect WAS, okay, which typically means you have a second level, third level, wholly owned subsidiary. Reason why I mentioned this is because typically under Income Tax Act, many a times, wholly owned subsidiary is considered to be the first level relationship, okay. So loans which are given to wholly owned subsidiaries, okay, whether direct or indirect, okay, are permissible, okay, and guarantees by Holdco in connection with loan given to wholly owned subsidiary, okay, that is permissible, and guarantee by Holdco to bank in connection with loan to subsidiaries, okay, is permissible. Note that this is not to wholly owned subsidiaries, but this is to all subsidiaries, okay. So this could be not a wholly owned subsidiary as well. But the important thing, like was there in the earlier condition, okay, where entities in which directors are interested, this loan should be utilized by the subsidiary company for the purpose of its principal business activities. Okay, so that was as far as 185 is concerned. Moving on to 186, okay. 186, there are limits on layers of companies, and there are exceptions, okay, that if the company has acquired a company outside India and it has layers, more than 2 layers permitted by the laws of its country, it is allowed. And if it's required for meeting any rule or law in force, then it is permissible. To some extent, 186 tends to get ineffective, if I may say, because of the rules which have been introduced. So more than 2 layers of investment companies is by rules is now more than 2 subsidiaries. So it is, so earlier there was a backdoor route where you could convert an investment company to an operating company and still achieve the objective of of 2 layers. Now any subsidiary, okay, 2 layers subsidiary, more than 2 layers is not permitted. And second is, wholly owned subsidiaries are considered, are ignored for the purpose of layers. Now there is of course a debate in industry whether wholly owned subsidiary, is it first layer, or if I have 3 layers of wholly owned subsidiaries, okay, do I consider all of them as one, okay, and hence ignore those layers? That is a debate I would keep for another day, because both views are possible, at least I have seen. Okay. Second, the important aspect, okay, is the limits. Okay, the max limit of loan guarantee or investment, okay, without shareholder approval is 60% of paid up share capital, okay, and free reserves, okay, including SEC premium, or 100% of free reserve, whichever is higher, okay. The moment you exceed this limit, okay, then you need shareholder approval. Prior to that, you can do it with board approval. The important aspect is every transaction, okay, of loan, you need to charge interest depending on the tenure of the loan. So the GSEC rate, which is closest to the tenure, okay, that has to be charged. Now, one aspect over here which is important, okay, is the Act does not look at forex loans separately. So, for example, if you've given a loan to a subsidiary, okay, it requires you to compare it with GSEC rate, which may not be possible. So, for example, you have a European subsidiary which, let's say, has a 2% or a 3% rate of interest. Okay, you would not charge a GSEC rate okay, 6-7% rate of interest to this entity, in these situations, you may have a challenge, and under CARO you need to report on 186 compliance as well. Okay, so under such situations you may have a challenge in terms of determining, okay, how do I determine compliance, okay, with 186 when the rate of interest, okay, is lower because it's a forex rate, to my GSEC. Okay, so one of the methods which you could consider, okay, whilst it is not written anywhere, is you take the forex rate and add the forward premium. Okay, let's say you have a dollar loan, you add a the INR dollar forward premium, okay, to that loan, and then compare that with GSEC rate. Okay, in one of my clients, we've taken a position like that. Okay, but it's something that there is no guidance really, and somebody will need to exercise judgment in terms of determining how to achieve compliance in that situation. Okay, if a company is defaulted in repayment of deposits, okay, typically the section 78 deposits, okay, then, or the interest on those deposits, then it is not permitted, okay, to give loans till the deposit is till the default in the interest or the repayment is cleared off. Okay, so that is 170. So that was 186. Coming to 177, which is so this is the last section on Companies Act which I'm taking. Okay, one is that audit committee approval is required for all transactions as well as subsequent modifications. Audit committee has a typical provision of omnibus approval. Okay, and they can fix criteria for omnibus approval, which the criteria needs to be approved by the board, and they see various factors, okay, like repetitiveness of transaction, okay, business need, okay, to keep coming back to the audit committee, etc. Under those circumstances they can do it. Okay, if the if a lot of details are available about the omnibus approval, okay, they can the like name of related party, typically clarity on what the type of relationships are, okay, then a higher omnibus approval can be given. Else, if a blanket approval has to be given, it cannot exceed 1 crore. And the omnibus approvals are required to be renewed every year. Okay, they are effectively valid only till a financial year, whether exercised or not. Okay, and if it has to be done again next year, okay, then a fresh approval has to be taken. Omnibus approval cannot be given for selling off or disposing of an undertaking. Okay, for those you need an approval of the audit committee at a meeting. Okay. The next part that I'm moving on to, okay, is SEBI amendments. This is for people who are doing listed companies. Okay, Reg 23 is important, and it was an important change which SEBI brought in. So I'll just take you through the gist of those 3-4 changes which came in. So I put in the earlier provision and the revised provision. Okay, so related party for SEBI is nothing but 276 plus accounting standard. Okay, in simple terms, that part actually has been kept the same. Okay, so this part is really the same in the existing definition as well as the new definition now which has come in, the erstwhile definition and the new definition. Okay, the proviso, okay, where certain parties deem, okay, the deemed related party, that has undergone a significant change. Now what's the change? So earlier, okay, a person or entity belonging to promoter group had to hold more than 20% to become a related party. Okay, so provided any person or entity belonging to the promoter group and holding 20% or more of the shareholding shall be deemed to be a related party. So if somebody, if a promoter group entity, okay, or a promoter was holding less than 20%, let's say 19%, 10%, 5%, okay, he was not treated as a deemed related party. Now this and has been changed to or firstly, which means that every promoter and promoter group entity, irrespective of the shareholding, even one share, okay, will become a related party. And second is any person, okay, so if you make this or, the 20%, every person holding 20% or more becomes a related party. Okay, anyway, by virtue of Ind AS 28, okay, presumptive influence 20% does become a related party. Okay, but the important thing is from April 23, this 20% becomes 10%. Okay. So any entity holding 10% or more of shareholding becomes a related party. This clause, okay, will be interesting to see when it comes. Why? Is because LIC holds 10% in many companies. So, for example, ITC Limited, I'm aware of, LIC holds more than 10%. Okay, so LIC will become a related party of ITC, presumably. Does that really make sense, or is there a dichotomy which the regulator has not foreseen? That is something we kind of need to see. Okay. Second is this holding has to be evaluated. Okay, this part is important during the immediately preceding financial year. So you could have a situation where for year ended March 22, the shareholding was 10%, and then the next year the shareholding is 0. But you will have to show it as a related party if there are transactions with that party. So it's a very, very unique, or if I may say, a different the way in which SEBI has looked at this entire related party standard. So the determination is based on preceding financial year, and the transactions are of the next year. Okay, so that is very interesting to see. Because I believe when 10% or more comes in, that's where the real trigger will come in. For current year, the threshold which is applicable is 20%. So just to reiterate, every promoter or promoter group entity is now a related party. Okay. Second is people who are holding more than 10%, any person, okay, is considered as related party. From April 23, person holding more than 10% becomes a related party. But these thresholds are based on previous shareholding. Okay. Second is related party transactions. So, during my earlier slides, I kept alluding to this, that, under SEBI, a group form of related party, okay, has, come in. Okay. So I'll cover that in the next slides. Okay. But before that, I'll get to this. What is a related party transaction? Okay. So one is transfer of resources, services, or obligation. This is something which is borrowed from Ind AS 24, and it remains. Okay. So between a listed entity and the related party, okay, that is considered as a related party transaction. Okay, which is fine. Now, what has that got changed to? Okay, that has got changed to a related party transaction means a transaction involving transfer of resources, services, obligation between one group. What is that group? A listed entity or any of its subsidiaries on one hand, and the related party of the listed entity or its subsidiaries on the other hand. Earlier, so what is so different out here? Okay, if I have a listed entity H, okay, and its subsidiary S, okay, earlier, okay, a related party of H did not have any implications on my disclosures for S. Now we are saying a related party of H, okay, is a related party of S, and a related party of S is a related party of H. Okay, so it looks at it at a group level. So listed entity on subsidiaries on one side, and any related party of this entire group on the other side. So if any transactions are there, those need to be covered. From next year, okay, it is from April 23, it gets even worse. Okay, so it moves out of group, and it says now the reason. So this is something that I can probably conjecture a reason why this has been introduced. Many a times, to bypass disclosures, okay, companies in India may use pass-through entities, okay, where entity A wants to transact with entity B, but it introduces entity P in between. Okay, so A does not interact with B because it's a related party transaction. So A will do a transaction with P with the intention that P does a transaction with B. So whilst this easier said than done, okay, but it's difficult to fathom sometimes. Okay, but if the transactions are so large, okay, that they cannot be hidden, then this disclosure may get triggered in certain situations. So you have a listed entity and or any of its subsidiaries on one hand, and any other person on the other hand, the purpose and effect of which is to benefit a related party of the listed entity or its subsidiaries, okay, with effect from 1st April 23. So So this is much broader, okay, much broader than the current definition. But the current definition which is applicable is listed entity or its subsidiaries with related parties of any of these entities. Presumably that the intention here is only listed entity and subsidiaries. Okay, it does not go to JVs and associates. Okay, at least for year ended March 23. So the following, okay, are not considered as related party transactions. So typically, the transactions which are done following regulatory approval mechanisms, if I may say, those are not considered as related party transactions. So because there is a set process of doing it, okay, so preferential allotment, payment of dividend, division of shares, buybacks, bonus rights. Okay, all of those are transactions which are, there's a prescribed procedure in law. If those procedures are done, okay, then these are for SEBI purposes not considered to be related party transaction. Okay. The next important aspect is materiality threshold. Okay, so if transactions are material, okay, they need shareholder approval. Okay, and we'll come to that. So this slide deals only with what is materiality. Okay, so we'll go to the earlier definition and we'll come to the current definition. A transaction with a related party shall be considered material if the transaction taken individually or with previous transaction during the financial year exceeds 10% of the annual consolidated turnover of the listed company as per the last audited financial statements. Now, this threshold of 10% has been changed to 1,000 crores or 10%, whichever is lower. Okay, that is the main change really. Okay, so thresholds have been revised and the turnover percentage, okay, is as per the previous year. That continues. Okay, the turnover threshold. Now, one important aspect over here, okay, which is there's lack of clarity on how to handle multi-year transactions. Okay, it's very difficult, okay, to do to evaluate for multi-year transactions. Okay, because what happens, let's say for example I'm entering into a contract with somebody for 10 years. Okay, and the contract, okay, is a 5,000 crore contract. But if I look at, or let's say a contract of 1,200 crores to be just, maybe to take it just above the threshold. Okay. Now, if I look at this contract per year, it is, let's say, 200 crores. Okay. But if I take it over 10 years, okay, this contract is 1,200 crores. Okay. Some year it is 50 crores, some year. Okay. But in the first year, let's say it is 200 crores. Now that 200 crores doesn't breach the materiality threshold, okay, of 10% or 1,000 crores, whichever. So hence shareholder approval is not required. That's one view. The other view could be that this entire transaction, okay, is one transaction, because once I enter into that transaction, I cannot come out. So do I look at this as 1,200 crores against 1,000 crores? The argument against that is that the turnover is only a 1 year, whereas the contract is a 10-year contract. So there is lack of clarity on this, which approach is right. There is no guidance on that. Okay, but this is an important consideration which one may take consider when you're evaluating your own listed clients. Next is prior approval of the audit committee. Okay, all related party transactions, okay, require audit committee approval. This substantially is the same, okay, except that they've added that material modifications, okay, also shall require audit committee approval, which I believe was always the intention, but this has been specifically clarified. The other important change which has been made, okay, is as far as these transactions are concerned, only independent directors, okay, can vote or approve on related party transactions. Okay, this is really, onerous in a sense. Okay, it makes the job of independent directors, okay, very onerous, because they are the ones who are taking a call on whether this transaction is correct or not. Okay. So this is an important change. Omnibus approval continues. Okay, there is no change as far as omnibus approval is concerned. Okay, there are certain other provisos, okay, which are added. Okay, the audit committee of a listed entity shall define material modifications and disclose it as part. So basically, what is meant by material modifications is something that is to be defined by the audit committee, okay, and disclosed as part of its related party policy, okay, on materiality. Second is a related party to which a subsidiary of a listed entity is a party, but the listed entity is not a party, shall require prior approval of the audit committee. Now, this is something, which is if it exceeds a particular threshold of 10% of consolidated turnover. What this basically means is that I'm a listed entity and I have a subsidiary. Okay, the subsidiary has a transaction with somebody. The subsidiary has all approvals, but because it exceeds 10% of consolidated turnover, it needs the listed entity's approval. Okay, this is something that is unique, okay, which has been kind of created, and with effect from April 23, okay, a related party transaction to which a subsidiary of a listed entity is a party, but the listed entity is not, shall require prior approval of the audit committee if the value of such transaction exceeds 10% of standalone turnover. From next year, the threshold is changed from 10% of consolidated turnover to 10% of standalone turnover. Okay, so if there is a related party with whom the subsidiary has a transaction, but the listed entity does not have, from next year, if it exceeds 10% of annual standalone turnover, then it shall need audit committee approval of the listed entity. So basically, it means that the listed company's audit committee's obligations, if I may say, those are wider as compared to those which were there earlier. Certain other things, if a listed entity, okay, has another listed subsidiary to which Reg 23 is applicable, then this approval is not required, obviously, because the listed subsidiary itself will go through this entire approval process, and hence no further, approval of the other topco listed entity is required. Okay, then approval of shareholders. What we discussed is materiality, and we said if a transaction is material, it needs approval of the shareholders. Okay, now there are some significant changes over here. Okay, so shareholder resolution was required, and no related party, okay, could vote on a transaction, okay, of this type, okay, on which shareholder approval was required. Certain important changes. Okay, one is prior approval of shareholders is required. Now, this is something which could be very onerous because companies at times may not be able to fathom and accurately predict, okay, all types of transactions because business is dynamic. But prior approval of shareholders is required through a resolution, and no related party, whether it is a party to the transaction or it is not a party, but it's identified as a related party, okay, it cannot vote on that transaction. Okay, provided that prior approval of shareholders is not required, okay, for a related party transaction to which a listed subsidiary is a party, but the listed entity is not, if Reg 23, okay, is applicable. Again, if there's a listed subsidiary who's following this Reg 23, then again approval is not required. Okay. There are certain exemptions, okay, from related party transactions. Okay, the change basically, which is important here, I'm just going a little bit fast because of time. Okay, is earlier transactions between two wholly owned subsidiaries, okay, of a listed holding company, okay, those were not exempted. Now those are exempted. Okay, in addition, okay, to transaction between holdco and was, okay, those which were exempted, but transaction between two was of the holdco, those were not specifically excluded. Those are now kind of excluded under the revised Reg 23. Okay, so that is as far as the listed Reg 23 goes. Now, there are certain aspects which I just thought relevant to cover from a CARO perspective, and I'll go fast over here. Okay, CARO, this is just to show where all related party has a touch point. Okay, so CARO has been amended, as you know. Okay, and significant, the March 22 numbers or audit reports had CARO disclosures, extensive disclosures. Okay, and some of the disclosure, of course, you had disclosure relating to lending and going concern, and all of the fraud and auditor resignations, etc. But also a significant part of it was relating to related parties. Okay, now some of the clauses, okay, may not be specifically stating related parties, but I've covered them because they somewhere would allude to related parties. First one is on Benami properties. Benami property, even though it doesn't state it's related party, but typically it will always be relating to a group, or so reporting is required on Benami transactions. Okay, but only those reporting where any proceedings have been initiated by the income tax department. Okay. Second is on investment guarantees loans. This is subclause 3. Okay, where certain reporting is required in terms of loans, advances, or guarantees which are given. The last one is important, where loans are given on demand or without specifying the terms of repayment. Okay, then you need to state the amount, and specifically the amount given to promoters or related parties under 276. Then certain compliances, specific compliances with 185, 186 are to be disclosed. Like I said earlier, okay, 186, okay, if you recall, I spoke of forex loans, okay, which are granted at forex rates, and when you compare them with GSEC rate, okay, they may not be at arm's length apparently. So such kind of clauses, okay, typically may create a challenge. And many other clauses are there, under 185, 186, which may not be so clear. Okay, but the auditor's obligations, okay, are much more now, okay, under CARO, under related party reporting. And hence one, as an auditor, if you are an auditor, you need to be very careful when you kind of report. Okay, then you have clause 9, ENF, where the company, whether it has taken funds from any person to meet obligations of its subsidiaries. You will see this coming very often in many of the reporting that I have done. Okay, this clause is very, very common, where you meet the obligations of subsidiaries. Okay, you take loans, etc. So that reporting is required. Okay, and whether you've taken loans on pledge of subsidiaries, shares of subsidiaries. Okay, whether you've raised loans. Okay, and whether there is a default, okay, in repayment of such loan, that is also to be disclosed. Then compliance with 187, 188 and 177, that is also required. Compliance with non-cash transactions and CIC. On CIC, one aspect I'd just like to clarify. Okay, on CIC there is there are two views which are there in industry. One is whether the clause, okay, applies only to that entity which is a CIC, and hence clause let's say 16D applies only to people who have CICs and is there one more CIC in the group, or does it apply to any company? Okay, because the definition of group, okay, is as per RBI and it's not as per accounting standard. And under RBI, even if you're a company under the same brand, okay, then you would be a related then you would be a company as part of you'd form part of the group. Okay, so let's say, for example, you take Tata, if any entity of Tata is using the same brand, okay, they all become part of the group as far as RBI definition is concerned. Okay, now under that, if you take a position over there, okay, then whether there's a CIC in the entire group, which is beyond your scope of reporting, effectively beyond your, if I may say, access to books of accounts as an auditor. Okay, all of those, parties come under the reporting. So which clause is applicable and what interpretation is to take? I think there are, multiple views in the market currently in terms of market practice. Okay. Then two other things, on which reporting is required. Okay, one is on Rule 11. Okay, there were certain amendments which were made during the current year in Companies Act and in the auditor's report, basically on fund movement. Okay, whether companies received funds, okay, with the intention, okay, that they have to be given or invested, okay, in to somebody else, okay, or company has given funds, okay, to somebody with the intention okay, that the fund shall be invested somewhere else. Okay, both those elements have to be reported. Okay, and the management has to represent to the auditors, and the auditor also has to report, okay, that based on such procedures, okay, that the auditor has considered reasonable, nothing has come to their attention that the representation made by management, okay, is incorrect. Okay, so that's what the auditor needs to report. And lastly, okay, whether the dividend declared, okay, is in compliance with the Section 123 standard, okay, of Companies Act, okay, Section 123, whether it's been done on in compliance with Section 123. So these are some new clauses, okay, on which the auditor needs to report. Now, on the audit procedures, okay, I'll just go quickly over here. Okay, as far as essay, so what we covered, okay, is typically on identification of related parties, okay, various sections and various, if I may say, regulations which are applicable, various types of transactions which are covered, okay, what are the nuances of each of those transactions, okay. So as far as the standard is concerned, SA 550, okay, deals with the audit procedures on related parties, okay. These of course do not consider the procedures, okay, which the auditor may need to perform for CARO, etc., okay, which is a specific, reporting to be done. So those could be not covered by SA 550 specifically, but those are separate procedures. Now, some of the important aspects, okay, which one may consider for the purpose of related parties. One is the risk assessment of the susceptibility of the financial statements due to fraud or error due to existence of related party transactions. So at the time of risk assessment, you need to assess, okay, whether there is an existence or there's a possibility, okay, that it depends on your past history. Suppose your past history indicates that the management is not disclosing a lot of parties, okay, then you may want to identify it as a fraud risk or a risk of error. Okay, evaluation of processes and controls that management has in place to identify related party transactions. So this is very, very important. Let's say, for example, you're doing a large company which has, let's say hundreds and thousands of debtors and creditors. Okay, is it identified at the stage when the vendor account is created, okay, or not? Or is it a separate process? If it's a separate process which is not at the stage of vendor identification or customer identification, and it is not tested every year, the risk could be much higher that a related party relationship is not tested. What is the level of data exchange between the company secretarial department, okay, and the business in terms of sharing information on transactions and identification of parties? So those are important elements. Reading of minutes, all declarations given by directors, okay, those are important from an auditor's standpoint to be considered when determining who is a related party, because all declarations given by directors on which people, okay, or which entities they are interested in, okay, those will be related parties. Then also evaluating the list of investments, okay, which the company has made, if they associate subsidiaries, okay, special purpose entities, all those are to be given. Then also on various forms, AOC 1, AOC 2, okay, which are the contracts and arrangements, okay, those an auditor will need to go through. And most important also, okay, is the list of debtors and creditors. And in today's times, really, searching on the net in terms of any kind of relationship that you may find, okay, in terms of, and of course following it through to determine that it is authentic, okay, that would be important from a identification of a related party transaction. Also, what is important is whether the transaction is in the ordinary course of business. Like I mentioned earlier, there is an extent of judgment, okay, which is required in certain cases. Most cases, I believe, okay, ordinary course should be okay. It is only in certain specific situations that you may find that the transaction is not an ordinary course of business. And like I said earlier, it's not only the nature of the transaction, it's also the terms, okay, of the transaction, whether it's an ordinary course of business or not. And the auditor is also required to evaluate the presence of fraud risk factors, okay, when determined. Typically, if there is a risk of ciphering of funds, or any of those kind of red alert matters, okay, then and your past history of auditing those companies, okay, you need to evaluate whether the fraud risk factor exists. And if the management makes an assertion that the related party transactions are at arm's length, then you need to obtain sufficient appropriate evidence about the assertion. Like I said, as far as Ind AS 24 is concerned, okay, you need to, if you have sufficient data, management needs to make an assertion out there that these transactions are at arm's length, even though it's a disclosure standard. But the auditor will need to have, adequate evidence backing that assertion with him in order to arrive at that comfort that the transactions are at arm's length. Sorry. And in forming an opinion on the financial statements, the auditor is also required to evaluate whether the accounting and disclosure of the related party transactions is in accordance with applicable reporting framework. Typically, if you're doing Ind AS, then Ind AS 24 or AS 18, or respective Companies Act, which may, or any other, let's say any other regulation which may require the disclosure. Okay. And evaluate whether the related party relationship and transaction prevent the financial statements from showing a true and fair view, okay, or cause them to be misleading. So he needs to evaluate it and then decide the reporting if that's not the case. Okay. So these are few matters which I thought I'll bring to the attention of my audience. Thank you very much for giving me this opportunity. And Anil, back to you. If there are any questions, I'll be happy to take those.
Thank you so much, sir. Thank you so much. It was a very wonderful deliberation, and more than 1,266 participants are here. So more than 1,266 members are still here, and there are a lot of questions. So if you permit, can I ask certain questions?
Yeah, sure.
Yes.
It's dangerous to take question directly. Yeah, tell me.
Sir, first question is, in case if non-refund of loans due to the non-availability of loan party amounted to default as private limited company is prohibited from continuing the loan from other party, how to qualify the report if CARO is not applicable?
Sorry, can you repeat that, because there's some noise at the background where you were speaking.
Please answer. Sir, in case if non-refund of loan due to the non-availability of loan party amounts
Non-availability of?
Non-availability of loan party.
Okay.
Amounted to default as private limited company is prohibited from the continuing the loan from other parties. So how to qualify the report if CARO is not applicable?
So one is, if you have a loan which is receivable from somebody and you believe that the loan is impaired, okay, due to any reason. I think the reason is not relevant here. Okay, whether he's getting the loan from somebody, not getting the loan from somebody, he's eligible, not eligible, his credit rating up, down, doesn't matter. If he's not able to repay the loan, and of course this is outside the scope of this session, but still I think if the loan is impaired, the party is not able to pay, the amount is material and it is beyond your materiality threshold, then you have to, either the client has to provide for that loan, or then you have to qualify it, stating that this loan has been impaired and has not been provided, and hence my opinion has been modified to that extent. Okay, so that's a simple one, I guess.
So in case of an individual, if a person is not related but making significant influence on him, in that case substance is more important than the relationship, whether they will be related party.
Yeah, under Ind AS 24 it is a related party, clearly.
Can we have scenarios where we can find out the purpose and effect in related party transaction with third party? How can we reflect this in our related party reporting?
Oh, can you repeat that? That was interesting.
The question is, can we have scenarios where we can find purpose and effect in related party transactions with the third party? And in the next question in the same, how can we reflect this in our related party reporting?
No, so this is the element that I spoke of under SEBI. Okay, where let's say, for example, I'll give you a theoretical example. Okay, let's say, for example, you want to do a buyback, and you are not able to do a buyback, and you get a third party to do a buyback of the shareholders' shares. Okay, effectively you're changing the shareholder. That third party is doing a buy. So to give a more clear answer, okay, there's a company C, okay, there's a shareholder S, okay. You need to do a buyback of the shareholder S, but you are not able to do a buyback because you're not able to comply with Companies Act, okay. You get another party in between who's an unrelated party who buys the shares from S, and you are giving a loan to that party against the guarantee of some security, okay, to that party. So basically you have done a transaction of giving a guarantee, okay, to another party to effectively benefit your own self. If I don't know whether I've answered the question, okay, but this is very difficult to determine, okay, very difficult. It could be very specific, and I'm presuming that it would be a transaction which would typically be very large and hence very noticeable, okay. But if you're talking about very routine transactions, I don't know whether one would be able to identify those transactions.
Yes. One question is relating to this disclosure requirement. A member is asking, what is the disclosure requirement if services are rendered free to a related party? And what would be the services are rendered free to the related party? So what would be the implications for tax audit as well as GST, if you can help?
Okay, so tax audit and GST, I would stay away. I'm not an expert and hence do not want to comment on
what
that.
are the various
But as far as
requirements?
as far as Ind AS 24 is concerned, because there is no amount which is determined out there, you would give a disclosure in the notes that there is a party A or a party B with whom your reporting entity has transacted, and so these services have been rendered to the party free of cost, okay. And typically, as I understand, if this transaction is material and it does trigger domestic transfer pricing, I presume that it will need to be valued, and appropriate tax would need to be paid on this transaction by the party rendering the services. But I'd like to stay away from income tax and GST, not my area of expertise.
So another question is, if a company is having beneficial interest in a trust, who is an independent trust, and even trustee is appointed by special bench, can we exclude that trust from related party disclosure since it is not controlled by the company?
You need to repeat this one, sorry.
Yes. Question is, if a company is having beneficial interest in a trust,
okay,
who is independent trust, and trust is appointed by special branch.
Trust is
appointed by special bench.
Special bench, okay.
Yes. So can we exclude that trust from the related party disclosure since it is not controlled by the company?
Okay, I can't answer this question. We'll need to see the specific term. Sorry, normally I would, if it's a trust which is formed for the benefit of the company, then I would presume, I'll give an example. If it's a trust which is an employee PF trust, okay, which is for, I would consider this to be, somewhere related, okay. But if it's created by a bench, sorry, I have never come across a situation like this. Okay, we'll need to check the terms and
yes. We will kindly take your time and forward the query. I will forward to the member.
Yeah, sure.
Yeah. One question related to Ind AS. Member is asking, from Ind AS perspective, can you please help us in defining the meaning of close family? What is close family as per Ind AS?
So close family, I mentioned, close family is parent, siblings, which is brothers, sisters, spouse, or spousal equivalent, girlfriend, or whatever you call it, okay, and children, legal or not, okay, all will be related parties as far as Ind AS 24 is concerned of the individual.
Whether loans and advances can be given to directors of private limited company or like small company, what are the limitations?
So I think I covered that actually during the session. So
one member is asking again. I hope he has missed that part.
Yeah. So you can give a loan. Okay. There are certain conditions. Okay, under 185, and there are certain conditions for private limited companies or special resolution, and the loans being utilized for purpose of business.
Are the children of brother or sister children of brother or sister considered as related or related party?
I do not think so. One is, depends where. Okay, if this is pertaining to Ind AS 24, so please do not hold me for this, because it's sometimes you need to read the definitions carefully to answer. Okay, but to my knowledge, the children, your children, the individual's children are considered as a close family member. The children of brother and sister, I think, may not be considered under Ind AS 24. Okay, I'm not getting to definition of relative under 276.
So we will
Big
take
question,
more
I
two
mean.
questions. If one unlisted entity holds 50% of the share capital of another unlisted entity, one unlisted entity holds 50% of the share of capital of another unlisted entity without any representation on the board of directors of the unlisted entity, wherein it holds the 50%. Would these two unlisted entities be termed as related parties?
Yeah, because it will be an associate, right? So under Ind AS 28, okay, if you're holding more than 20%, there is a presumptive significant influence, and hence it will be a related party. So they may not be control, or they may not be joint control as the person is indicating, may not be, but at least at the minimum there will be a significant influence presumed. So you can't say that I invested 50% in a company and I have no relationship with that company. So it's a very rare situation.
So who should be the compliance officer in company to ensure the related party disclosure?
So generally, it's the company secretary, I presume. I'm not great at secretarial standards, okay, but I think it's the company secretary.
So last question, one member is seeking your experience with the clients. To what extent have companies been able to leverage technology to help in the compliance and reporting of related party transactions?
I think this is a brilliant question, honestly. Very, very brilliant question, especially if you're doing very large companies. Today, you cannot ensure compliance without use of technology. For example, some Johnny somewhere in the company at some plant, okay, does a transaction with some party, and a vendor code is opened. There is no way that somebody at corporate will come to know that unless there's a process set and there is a technology to identify. So the technology piece is very, very relevant. I'm very happy that somebody raised this question. If your company is large, or you're auditing a company that is large, I think technology is very essential. Otherwise, you run the risk, because the definitions are so convoluted and complex that for you to physically identify, and many of these are applicable during the year also. So for you to do testing during the year, at any point of time during the year, you cannot do it without use of technology. So I think this is I would treat this a very, very intelligent question, very smart question, and but answer is yes, you would need technology.
Thank you so much, sir, for sparing your valuable time. It was a wonderful experience to have with you over here on various intricacies on related party transactions. So on behalf of WSP of ICI, once again, I extend my happiest thanks towards you.
Well, I'm very thankful to you. Thanks for inviting me. And thanks to all who've had a patient listening. Okay. And I hope I've added, maybe my 2 bits to your knowledge. Then that's been my attempt. Yeah. Thank you very much.
No, sir, it was great deliberation. Thank you so much.
Thank you so much.
Thank you, sir. Thank you.
Bye.
Recording stopped.